Shannon, good to have you here this morning. I want to talk some macro first. Another really bad employment situation that we continue to see unvolved with the latest jobless claims. But it seems markets have understood this situation. Is this going to be the norm where we can kind of breeze through the bad data as long as the virus is retreating?
I think it depends on the data. I think that the jobless claims numbers are, I would say, expected, given the number of low-wage workers that we have in the United States that are associated with restaurants and bars, retail trade, and hospitality. I would say yesterday, the retail sales numbers were much worse than expected. And I do think that the weakness that we had in the market yesterday was as a result of, I think investors expected those retail sales numbers to be abysmal for April. But not quite as bad as the ones that we saw for March yesterday. So I think it depends on the data point. I do think that the headline risk of the coronavirus and the duration of the shelter in place and stay at home mandates, I think that is the critical piece of information that we're looking at right now, because it allows you to then frame out the rest of your expectations for the year.
If we know that the numbers are going to be bad for the economy and the expectations are bad, what is then the best way this market stabilizes or continues to grind? Is it just that virus turning from a flatline curve to downward and us getting back to work? Do you have to have some special insight into human behavior and what it looks like on the other side? It seems like there's just so much kind of guessing here, Shannon. Everybody says, oh, well, I think people are going to do this afterwards, but someone else says, I think people are going to do that.
Well, it's the most challenging thing, and it's why, analysis, particularly fundamental analysis, is very difficult to apply in this type of environment, because you don't know exactly the discount factor that you need to be putting on revenues for the rest of the year. And so I think the most important step is obviously to get us back into more of a normalized environment. I think expectations for consumer spending to return to pre-crisis levels, by the end of the third quarter are very optimistic and probably inaccurate. So I think what you need to do is I think we need to see people start to enter back into society, because if we do get a pickup in the infection rate again, how will we grapple with that, and how will that change our views on social distancing for a longer term period? So that consumer spending is obviously one piece of it. We're also seeing concerns about that second wave, or that second derivative of the job losses we've seen now. You saw Google's announcement yesterday that they're putting a freeze on hiring, essentially. Google's not necessarily grouped into a bunch of companies that are directly impacted by the coronavirus. So I think that's important for us to get back to work and then see how our behavior has changed since, as we're moving through this virus protocol.
One of the things I see in notes I think is pretty interesting is that investors shouldn't feel the need to invest in beaten down cyclicals in this moment. This has been, I think, a fairly debated subject from the guests on our show here. About half say that this is a great time to buy things that are about to come out of a recession or a recessionary-like period, and those will be cyclical and industrial in nature, and others say steer as clear as you can from those. So walk me through the logic here from the way you see it.
Typically, if you look back at all of the last recessions that we've had, particularly the last four recessions, if you had been a buyer of cyclicals at low or near low levels, you didn't necessarily have to time the bottom. You were better off 6 to 9 months after the recession if you had bought those cyclical stocks. However, going into all of those recessions, there was an economic imbalance that created the opportunity for recession, and was something that the Fed was reacting to through tightening. And so without that imbalance, we're looking at the prospects for lower, slower growth, continued lower interest rate environment. We don't see a lot of difference between pre-crisis and post-crisis, and therefore it's difficult for us to understand why these very deep cyclical stocks in areas like energy, materials, heavy industrials are likely to outperform just because we've entered into a high volatility and large drawdown stock market, and a technical recession, but not a recession caused by an economic imbalance.
I think this is pretty interesting because there's a debate to be had, right? I mean, the kind of what worked before and what works after. Basically, the point is, look, don't try and kind of fight the dynamic that we had prior to this, that life and therefore the market is going to look somewhat similar on the other side. In terms of stocks, What does that mean? Does it mean tech? Does it mean the type of NASDAQ consumer services companies that have been doing well the last couple weeks are going to do even better now going forward?
I think it's important to differentiate. So if you think about some of the communication services companies, things like advertising revenue are definitely going to decline. If you have consumers spending less money, there is evidence that, similar to after the 2008-2009 financial crisis, that consumers will use this opportunity to perhaps increase their savings rate. So there are going to be areas of quote unquote growth stocks that are not necessarily going to do as well. What I think is that we're going to be entering into a period where valuation does become more important. And so it's not just going to be every growth stock in the universe seems really attractive on a 12, 18, 24-month basis. But I don't think we're there yet. We can't really use those valuation metrics. So I would say it's going to be more selective, and we might have more of an opportunity to digest, which companies have a sustainable competitive advantage, which we believe can continue to grow in a lackluster economic growth environment. I think that, so I do think that growth will probably continue to outperform. The one caveat to that is that I do think that financial services companies really haven't participated in the rally the last several years because of the interest rate environment. I think there is going to continue to be differentiation in that sector. And there might be opportunities there, whereas I feel like people have just lumped that into the value rotation trade. And if that's not working, then financials won't work. So I do think it makes sense to be a bit more selective in that sector.
I see that right now within some of your stock picks, you have companies like Accenture, you have Salesforce, as you mentioned here, some of the financial companies as well, JP Morgan in there. I actually want to target one real quick, Verizon, but I think this is pretty interesting, the trend that they were trying to capitalize on with 5G, but they've dabbled as well in other areas in terms of content, not as much as AT&T, but actually just overnight, they say they're going to buy a Zoom conferencing competitor, Blue Jeans. It's going to be about $500 million for the deal, a little bit less. I'm curious what you think about this.
Verizon's been, different from AT&T. To your point, Verizon's really gone out and invested in spectrum, and AT&T's been looking to invest in content. We really like content, so I'm not faulting AT&T for that strategy. I think in the current environment, what we've learned, and whether it's those of us who are working from home or for those of us who have kids that are in school, whether in primary school or secondary school, they're here at home, they're utilizing, bandwidth, and there's going to be an opportunity for firms like Verizon to monetize their existing consumer and business base to be able to continue to grow. And so we believe that spectrum and 5G are going to become increasingly important over the next several years. We do think that there is going to be a change in the way that businesses operate, and we think Verizon's well situated to take advantage of that. We actually just purchased Verizon recently, so this was trying to capitalize on what we see as a trend over the next couple of years.